Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of October. So I'm going to be talking about the bottoming process that may take place for the stock markets. I'm going to do that towards the end of the video. I want to start the video by taking a look at some sector opportunities, the broad market opportunities as well. I'm also going to be using the Thackeray's 2023 Investors Guide as a reference point. So to start with, and here it is, the Thackeray's 2023 Investors Guide as a PSA. The 2024 book is going to be available in all 5 bookstores mid-November to late November. Here we are taking a look at the S&P 500's average performance in the month of October from 1950 to 2021. It surprises a lot of people to see that October tends to, the first half of it, up to 18 days, tends to actually perform quite well. October has a reputation of being a very volatile month, and it is. We'll talk a little bit about that, but we tend to find that the market can actually do quite well in this period here. And that's because it's an earnings month. It's January, April, July, and October, all earnings months. You tend to find this first half of the month actually running up into earnings releases as they start. There is a drop here. Even if you take out the 1987 drop in the marketplace, you still find you see a lot of volatility in this area here. And on average, October has been positive for the markets. This I call a bear killer. In 2022, my October newsletter, I talked about October being a bear killer, and recently on being in Bloomberg, I also talked about October being a bear killer as well. So this is where corrections and bear markets often end. In fact, it's the common month of the year for that to take place. And if we take a look here, we can see here on average, we up and down as most days in October, and the first part of the month tends to be positive, and you tend to find some negative days a little bit later on, trading days. If we take a look what's happening from this perspective on a sector basis, it's going to surprise a lot of people, but the information technology sector tends to be, on average, the top performing sector. Now, these sectors are all ranked by average gain all the way down here, and this is the frequency relative to the S&P 500, how often it outperforms. Here you can see the information technology sector on average does 2.6% in the month of October. Surprisingly, a lot of people don't know this, but the consumer staples actually performs quite well. We'll talk a little bit about that later on. Consumer discretionary, financials, healthcare. Let's go jump to the bottom. Look at this. Energy at the bottom. Energy has been on fire for a while. I know there's a lot of strong energy bulls out there, and I get it. The world's short of oil longer term, and it's going to need more oil, even transitioning to other forms of energy. But in October, it tends not to perform that well. And industrials here, look at this at the bottom, but it starts at seasonal period later on in the month, as does materials as well. So here's information technology. It tends to perform well from October the 9th, we're almost there, to December the 5th. And then it's got another period from December the 15th to January 17th. December 15th until January 17th. Now, this is a very short time period. I just want to have a caveat here from December 5th to the 15th. This is always a tough one because technology can, if it does have a run up here, it can pull back in this time period. If it's performing well, you can use technical analysis to help bridge that gap. But this has a high frequency of underperformance at this time. But the information technology sector can perform well, and this is probably going to be the sector that leads the market higher after a major capitulation at the bottom. Initially anyhow, at least in the first bounce. So we could, nevertheless, even if we saw some volatility in October, we could still see the information technology sector perform well. And here's the stats. Let's take a look at the monthly stats here from 1990 to 2021. You can see here that the median is the cross and the bar is the average relative to the diamond, which is the S&P 500. October tends to be a strong month, as does November as well. And you can see it going into December here a little bit. So, and here's Canadian banks. If you take a look here, Canadian banks have a strong seasonal period from October the 10th to December the 31st, and also from January 23rd until April 13th. But let's take a look at this seasonal period here for Canadian banks. Now, I've actually separated in the book out the month of December, and I did this with the stats here. I go all the way down here to show you that the month of December is good for banks if they've got strong momentum. But when do the Canadian banks start to release their earnings? It's at the end of November. So you can see them actually start to turn down at the end of November. Something to watch out for. But right now we are coming up to the time for Canadian banks. There is concerns about recessions and loan loss provisions as well. But if we start to see the Canadian banks actually start to gain momentum, it could be a seasonal trade. If we take a look at from a performance here on a monthly basis from 1990 to 2021, you can see the Canadian banks have outperformed. The diamond in this case is the TSX Composite Index, and here's the mean and median approximately the same in October. And in November, the performance actually pulls back a little bit here, and here we have a split, and this is really showing you what's taking place with that month of December, where the median can be high, but the average is lower in this case. So we've had a few large downturns after earnings that have pulled that average down, basically. So just something to watch out for. We'll take a look at the chart on Canadian banks coming up shortly as well. And if we go through here, flip all the way through, I'm not going to go through, I've got some stocks in here, Valero. I'm not going to go through all of the holdings as our seasonal trades here. I want to talk about home builders quickly though. Home builders has a long seasonal period from October 28th to February 3rd. Now, home builders have been on fire for a long time, many months, because there's been a lack of supply of housing in the U.S. market. People have locked in at 2.61%, which is the bottom for the 30-year yield. If they've locked in their mortgages at that rate, they don't want to sell when it's approximately 8% now. So there's been a lack of supply of resale homes. So who's made up for that? The new home builders have. And so they've really benefited. But so this sector comes up shortly, but we're seeing some problems in that sector. I'll talk a little bit about that later on. Here's the average monthly performance really in November, and then December tends to be the best month for the home builder sector overall. But nevertheless, it is a seasonal trade that can be evaluated. Emerson Electric, another one, you can look at that on your own. Retail, the retail sector, look at the retail sector. It tends to perform well from October 28th until November 29th. This sector has been in trouble for a long time. This is a strong seasonal period if there's a belief that the economy is picking up. The sector could at least bounce in this month period. So really what you're doing here, and this really exemplifies what seasonal investing is about, is you're getting in before everybody else gets in, because everybody else wants to be in approximately Black Friday as the holiday season starts. So that's a seasonal trade, but the sector has been underperforming, something to watch out for. It's not high on the list as far as a preferred sector at this time. But take a look at the month of November. Very strong performance that tends to take place in November on an average and median basis as well. Industrials, the industrial sector, October 28th to December 31st, and this sector could be one of the leading sectors once the market starts to turn around here, because where are investors going to go in the end? Is it going to be back to the technology sector, which I think could be the case initially on a bounce if we start to see, particularly if there's a strong bounce in the markets, but some of the cyclical sectors that are economically driven, because the economy still is showing some signs of life here, so the industrial sector could benefit. If we take a look here, on average from 1990 to 2021, the sector has actually performed quite well. It's not a huge difference on average relative to the S&P 500, but something to watch out for, just to try and capture that gain if it does look like the sector is actually going to perform well. The materials sector tends to perform well starting from October 28th until January 6th. And so it's got a similar seasonal profile to the industrial sector, but one can sometimes perform well versus the other sector as well. But overall, over the long term, they have a very similar profile. And you can see here that, in this case here, that November, the strongest month is really April for the material sector, and that's because of the commodities that are embedded in this. Now, the material sector in the U.S. is largely, approximately 70% chemical stocks, actually. But it tends to perform well in November, and also not that strong relative to the markets in December. But look at January. This is where you need to watch out for the material sector. But then we start to see a little bit of life come back into the sector as well. So January is the spot to watch out for as far as negative performance goes. Home Depot, if you want to take a look at Home Depot by yourself and take a look at the stats there, and you can see here, look at November and December for Home Depot. Metals and mining. Okay, so metals and mining, it's been really interesting. I'll show you this on the chart in a minute, but metals and mining has shown some life recently in some one day, every so often it tends to outperform very strongly, but it has a strong seasonal period from November 19th to January 5th. It can be very volatile in the month of October, so sometimes it can look like a good buying opportunity to step in early, but just something to watch out for, particularly if there's concerns about a recession coming up. This sector could remain under pressure. And you can see here that really the month of December tends to be the best month of the year for the metals and mining sector. Okay, UPS, if you take a look at UPS here, and then I'll finish it off here, and we'll look at some of the charts. But here's UPS along October 10th to December the 8th. This has actually been a good trade. Sells short December the 9th. So this is interesting because this is before the really busy delivery dates really happen for Christmas. So once again, it's seasonal investing is about getting into the sector or stock before everybody else. They'll get in because of they're expecting something to happen, such as increased Christmas sales, and then getting out when they get in. So you can take a look here. It's actually quite strong in the month of November. And look at December. UPS is on average negative, and the median's negative as well. And January, look at January. It's just there's no investors just don't want to be in the stock in general over the long term in the month of January. So, but right now this is a strong seasonal period coming up shortly. Something to watch out for, particularly if we start to see stronger consumer growth here. Okay, let's take a look at some of the graphs that match up with some of the sectors that are seasonally valid at this time, and a couple others as well. So here's the information technology sector. We're using the ETF XLK in the States. The sector actually has been heading lower. Now, don't forget the S&P 500 has been heading lower as well. In August and September, it was down 6.6% in total. But it's really been performing approximately at market. So this is the XLK relative to the S&P 500. So when the line's moving up, that means the information technology sector is outperforming, vice versa. But really, we've seen this consolidation period as the market really had difficulty in trying to determine where the money should be going. And, should we be going into the defensive sectors? Should we be moving into some of the cyclical sectors? So, there's a lot of people that like to rush back into the information technology sector. It's like the hotel. If you don't know what to get, this is where you go to get market returns. So a lot of investors view it that way. So we've seen this up and down motion for the information technology sector. If there is a major capitulation that takes place, this sector could be the one that actually, at least initially, leads the market higher from here. Canadian banks, look at this, and we're using the ETF ZEB relative to, in this case, it's absolute. Look at the consolidation that's been taking place. Actually, if I'm going to draw that line just a little bit better here, I'm going to draw a straight line going all the way across here, and we can see here just drawing that all the way here. Okay, there we go. So now what we see is a breakdown happening for the overall banking sector relative to the support. It's actually lower since the beginning of the year, and really it's substantial. If you have to go all the way back to 2021, once we get, if at this point here, we're getting close to it anyhow. We're in last October. We're approximately where we were last October. We're getting close to going back to all the way to 2021 as far as previous values go. But there's been some concerns that the Canadian economy with high rates is slipping into a possible recession, particularly because the housing industry could be in jeopardy with higher rates, and it makes up a large percentage of the Canadian economy. It varies, but it's approximately 9 or 10% of the GDP with its direct and indirect industries, which is huge because most countries are, while the U.S. is approximately 2 to 3% overall, so not nearly as much as the Canadian economy. So if we do see the housing market slip, and I know the Canadian banks will come out and say, well, we don't have a lot of exposure there, but it's the impact on the GDP overall that could actually affect the banks a little bit. Something just to watch out for. Now, I'm not saying that the Canadian banks can't do well in a strong seasonal period, because it could be a good trade coming up shortly, but we have seen this negative trend even recently relative to the TSX Composite here. So if we do see some sort of pullback here, we could see the Canadian banks actually bouncing in their strong seasonal period, or at least later on once we start to see the market turn higher. Okay, here's the home builder sector, XHB in the U.S., and here's relative to the S&P 500. Look at this. Look how well this sector's done. Oh, up until recently, of course. A little bit of a crooked line, but you get the idea there. And this has been because the sector's been benefiting from lack of resale houses on the market. but there's real strong signs saying that the home builder sector could start to be in trouble, at least on a fundamental basis. Home builders are starting to offer some big discounts to unload their properties at this point. They're embedding lower mortgage rates. They're trying all sorts of promotions at this point. And there's other signs that perhaps we could start to see the sector pull back a little bit as we enter into the strong seasonal period. So it's a little bit of a warning as far as that goes. But look at the relative to the S&P 500 here. And I'm just trying to draw this line. Here we are. We're starting to break down relative to the S&P 500 as well. So a sector that could do well for a short period in a seasonal period if the market does well, particularly if we see interest rates come down. So if we see interest rates move down rapidly for the, let's say, the 10-year yield, that actually could, and the longer term yield as well, that actually could in the short term give the home builder sector a real boost. So we could see that performance start to take hold. Something to watch out for, but we'll have to see. Here's the retail sector in the States. I'm using XRT for the retail sector, and as this is the retail sector relative to the S&P 500. First of all, we had all that nonsense back in 2020 and 2021 with GameStop and some of the other sectors, and it's kind of crazy. Then we had basically a consolidation. Then we've seen basically a pullback, and then we've seen a consolidation once again relative to the S&P 500. Really, we're going back to 2021, early 2021, to relative to the S&P 500. We've seen a decline in the sector. I guess there could be an oversold bounce, and the sector has been oversold on a full stochastic oscillator basis and RSI basis as well. So it's possible we could see a bounce in the in a strong seasonal period starting late October. That can happen, but I wouldn't count on this sector performing well over the longer term. This is the industrial sector, XLI in the US, and this is XLI relative to the S&P 500. And if we take a look here, we saw this strong outperformance in 2022. Now, that's relative to the S&P 500. The sector was actually negative, but what we saw was a real sell-off in the technology stocks in 2022. And as a result, some of the cyclical stocks actually on a relative basis actually performed quite well. But but that all got flipped, right? In 2023, we've seen that underperformance taking place. I'm just going to go back here and erase this. And what we can see here really is we've seen this consolidation overall taking place. Not the best lines there, but you can see that we're still in this consolidation period here a little bit. And we could actually see the sector actually do quite well starting in a strong seasonal period if we start to see the market advance. Because investors are going to be, it depends on how strong the market advances. If we see a really strong advance in the market at some point, the information technology sector is probably going to be, and the consumer discretionary will probably be the two sectors that really benefit from that. If it's a typical advance over time, we could see the sector actually performing quite well relative to the S&P 500. So I think a lot of that depends on the narrative in the markets and if the market's rallying strongly or not. Right now, I don't see the market rallying really strongly. We don't see the catalyst for that. But if we do see a further pullback, that could initiate something even on something small. Here's XLB. So this is the material sector in the States, and this is relative to the S&P 500. It's actually been in this box here, consolidating and underperforming the S&P 500. Recently, it's actually been doing a little bit better, but still been underperforming. And the narrative is really similar to the industrial sector and its relative performance to the S&P 500. So we could actually see this sector start to benefit shortly. This is the metals and mining sector using the ETF XME, and this is XME relative to the S&P 500. Really, we've actually been really fairly flat overall compared to, well, on an absolute basis for the sector, but we have seen these really strong days here. It doesn't show up quite so well in this graph, but it's really been up and down a little bit, and that's back in 2021. But the days here where we've seen some really strong pull up tick and then pull back, but overall it's been fairly flat. Look at this relative to the S&P 500 since June though. And this is the market peak, the S&P 500 peaked here. So we saw some outperformance for the metals and mining sector earlier in June and July. And as the market has pulled back, we've seen the metals and mining sector increase. This is actually a good sign overall for the sector and some of the cyclical sectors to see this developing and taking place, because This is showing that when the market was going up, it was outperforming, and when the market's been pulling back, it's been outperforming. The risk to this sector is if there's some strong concerns about the economy slipping into recession. That's when the sector will actually start to suffer a little bit if that does take place. If the unemployment numbers or some of the surveys in the unemployment space start to really indicate that there's some strong tendencies towards the economy cooling, this sector could actually start to really lag here a little bit. And this is really... And we can see that too, because this is when the narrative started to take hold. Well, the economy is actually not doing so bad. This is all about the soft landing. We're going to have a soft landing. So we've seen that outperformance. But nevertheless, seeing this performance for the metals and the metals and mining sector is actually being quite positive and does bode well for the sector if things are status quo and coming up very shortly as it starts the seasonal period in November. Here's UPS. I also talked about UPS and also UPS versus the S&P 500. Look at this underperformance that's taken place here. But let's go back, and I'm going to look at the performance relative to the S&P 500. Here's October last year, and look what happened. It outperformed in a strong seasonal period. Let's go back to 2021 here. Here's a strong seasonal period here again, and it outperformed. Sure, it had these things, but where you went up, you missed the up, and you missed the down. But in a strong seasonal period, it has this tendency to outperform. In 2021, that was not the case. We did see that pull back as it overbuilt infrastructure, and that was, they're trying to absorb it a little bit. But it's back on track, at least in the last 2 years, for its strong seasonal performance. We'll have to see what happens with UPS coming up shortly. There are other factors going on in UPS, such as wage growth and other factors. But from a seasonal point of view, where the company is oversold here coming into a strong seasonal period, so we could see that stock actually uptick here a little bit. So where do we stand in the markets right now? Well, if we take a look at what's happened in the marketplace, we've really seen the S&P 500 pull back a little bit. It's not a lot from the end of July. For August and September, only down 6.6%. That's not a big amount. It's typical that you'd see the stock market pull back, 10% once or twice a year. That was normal. I know it's been a long time because the Federal Reserve has been manipulating interest rates artificially and trying to take some of this out for years. Really, we can start to go back to 1999, but even after the Great Financial Crisis in particular, it's really been them manipulating the markets. But we're starting to see some seasonality come back to the markets. Typically in the summer months when the stock market would suffer, we'd see the Federal Reserve come around and start talking about doing a QE program or talking about how they're changing their minds or something to boost the market overall. And so, that took away from some of the seasonality, but that's not the case right now. You've got the Federal Reserve actually doing quantitative tightening, selling their bonds to the tune of $95 billion a month. So they're reducing their balance sheet. And this is not helpful for the market. That's aside from them raising rates to 5.5%. So we're starting to see the natural seasonal tendencies take place in the market. And so what's the natural seasonal tendency for the market in October? It tends to be very volatile. And it's hard to choose a bottom in October in the market. So I will say that because of the volatility that can take place, because you can see a drop and then an uptick again in the markets and then a pullback again as well. So last year what we saw the S&P 500 in 2022 pull back significantly. And so where did the bear market end? Well, let's take a look. Okay, so here's the S&P 500 here, and if we take a look, yikes, right at the beginning of 2022, we saw the stock market head lower. And we did see this bottom actually start to form at the end of late September. The bottom actually took place in October the 12th. We saw the stock market bottom out here. And earlier I talked about how last year in October I put out a special report saying October is a bear killer. We could be coming to the time where this bear market ends. And from 1950 to 2021, at the time now 2022, the S&P 500 has ended bear markets and corrections greater than 10% 13 times in the month of October. No other month comes close to that. I think the highest is, it's 4 in 1 month, where the bear markets and corrections stopped. So this is the month where we tend to see that as we start this favorable seasonal 6-month period. And then we did see the stock market, we did see it head higher here as well. And then we did see a pullback, and obviously we saw this. Now here's where May started. That's typically a weaker time for the stock market. This is the AI hype, and then we've seen that pull back here. And so the S&P 500 is positive for, since early May. But let's take a look at the equally weighted S&P 500 ETF RSP. Here we can see, well, this is interesting here. Look at this. We're actually down. We're negative for the year using RSP. And look at, here's May right here, early May. And oh, we're actually a little bit lower. So from May, the sell in May, we're actually lower for the equally weighted S&P 500. Let's take a look at the TSX Composite Index. Okay, so here's the beginning of the year for 2023 right here, and look at this. We are actually below that level, and you have to go back to earlier on in 2022 to find that level. That was last October for the TSX. And let's take a look at May here. Here's May. We're actually quite a bit lower for the TSX Composite. So the sell May has worked particularly well for the TSX Composite Index. Okay, let's get back and talk about where a possible bottom might form here in the market. There's no guarantees. Maybe the bottom happens in November, maybe it's December. There's no guarantees here, but on average, October tends to be the favored month for that to take place. And it tends to happen earlier in the month when we've seen a big correction take place in the market, particularly in September. Last year, the correction for the S&P 500 in September was 9.3%. I'm sorry, this year we're well behind that. So we haven't seen that large correction take place, which pushes out the possible buy date. We haven't seen an increase in volatility, I think, which also pushes out the perhaps opportunity instead from mid-October until versus late October. I think that now favors later in October compared to last year. This is largely going to depend upon the earnings. As I mentioned earlier in this video, I talked about how the stock market tends to run up into the earnings season start. And it's going to be interesting to see what happens as earnings are released to see how investors react to that. And if it's not positive, we could see the market really get into a little bit of trouble here, starting in mid-October and perhaps leading to a buying opportunity. So I think it favors right now perhaps a later in the month buying opportunity when the actual 6-month favorable seasonal period for the stock market forms. Maybe it is November, but it's uncanny over the years how often it is in the last few days of October. We'll have to watch and monitor to see if that actually happens. Thank you very much for joining me today.